Right, good morning, everyone, and a very warm welcome to this Brook Green Supply webinar. My name is Mark Westwood, and I'll be the host for your webinar. I'm Head of Industrial Sales and been at Brook Green Supply for just over 4.5 years. Just some items that we will be running through on this morning's webinar is, again, a bit of an introduction just from me on the CFP Energy Group. Lewis Harrison, who is one of our gas and power traders here at Brook Green Supply, will touch on the energy markets, wholesale markets. Luke Mallard, who is Head of Strategy and Commercial Innovation, will cover energy and non-commodity updates. And finally, Harry Halewood, our Head of Policy and Regulation, will give updates on the likes of REMA and other regulatory updates. So I know many of you might well be aware of Brook Green Supply and/or CFP Energy. So we are part of the CFP Energy Group. Brook Green Supply is the industrial and commercial supply arm. We also have a sister company called Cyber Energia that was formed in 2022 and was established to safeguard critical renewable energy infrastructure against evolving cyber threats. We also have Flex Power, who are German colleagues that deal with prompt power and also optimization of assets on the prompt market in Germany. Bit more on Brook Green Supply. So as I touched on, we are an industrial and commercial supplier offering natural gas supply, electricity supply, PPAs, green gas certificates, REGOs, and structured energy projects. We also work closely with a lot of developers and generators in terms of buying their power and their green certificates. So without further ado, just a couple of snippets on the webinar. There is a Q&A section. So if anybody does have any questions throughout the webinar, please do utilize that Q&A session. The webinar should last around 40 minutes, and we will allow for sort of circa 5 minutes for Q&As. And again, we'll also ask for a couple of minutes at the end of the session just to complete a quick poll, just to give us to ensure that we have the right topics for future webinars. So over to Lewis.
Morning all. So on the gas and power portion of this market update, we will be covering a bit of price development on both a month ahead and day ahead basis, a look at the actual temperatures, and then a look at the 45-day forecast, a few slides on gas storage levels, a bit on LNG pricing, Chinese LNG demand, the impact of the Trump policy, some fund positioning, and lastly, some market considerations for the balance of summer 25 and winter 25. So to start with, this graph is showing a continuous front month UK power and front month MBP price. And after a large bull run over the course of last summer, markets topped out at around the 140p mark on front month, with some key moments in pricing that have been labelled on the graph. So as we got to the start of February and the 45-day forecast almost took us to the end of winter, the narrative around the cool climate that we saw over last winter changed. Weather runs looked a lot warmer, and we saw a sell breakout from that high at the start of February. Next, there was a start to the change in mandate of EU storage levels. Following on from that, there was some talks around a Ukraine and Russia ceasefire that were instigated. And then finally, and most recently, the Trump tariffs that caused huge sell-offs across multiple asset classes and the commodity complex. And I'll go into more detail of this later in this portion, but this sell-off has been underpinned by fund positioning and a large amount of length that was held from that high at 140p. And off the back of this, the selling moves have been incredibly technically driven, with moving averages serving as key support levels and areas where we have seen breakouts and aggressive downwards pricing. This graph here shows day ahead power and day ahead gas. And I think other than a couple of days exemption, a common theme of weak renewables over the course of Q1 largely caused MBP and UK Power to move in tandem and pricing to mostly be driven by CCGT's marginal cost. And the kind of key moment in March was that we saw a negative base peak spread outturn, meaning that on the curve, this was translated almost instantaneously with peak pricing being slammed, as we're already seeing that relationship at the back end of March when typically solar generation isn't too high. And I think moving forward, the curve is going to be continually sensitive to how that relationship outturns in day-ahead markets as we move through summer. Temperature actuals. So over the course of last year, as I'm sure a lot of you are aware, it was far cooler than the last two, meaning that drawdowns on storage and overall demand was significantly higher. However, due to kind of a mild end to March and a kind of mild and slightly above seasonal norm start to April, injections have got off to a really positive start. And I think, as always, storage injections over the refilling period are going to be incredibly sensitive to weather. On a 45-day forecast basis, it's not quite warm enough yet in the UK for cooling demand to kick in, so that should mute demand. And I think a key area to look at moving forward is the back end of May, where we're seeing a significant amount of Norwegian maintenance. But as this is currently forecast to be slightly above seasonals, it's not looking like the system will be particularly tight and that the balance should remain quite loose. However, it's worth mentioning that if this changes and we have a bit of a cold snap at the back end of May, this could change. So it's one to keep an eye on. EU gas storage levels. So this has current storage levels at around 41%, with three forecasts moving on from that. So you've got the best case scenario, which models the highest injections that we've seen day on day over the last 5 years, which gets us to technical maxes by the back end of September. You've got a 5-year average model, which gets us to just over 85%, and then a worst case scenario, which gets us to just over 61%. I think the potential new target of 83% has most likely been calculated when we were at slightly lower storage levels, and then modeled to the 5-year average, because with the strong injection that we've had so far, that gets us to just under 86. Injections have been helped significantly by, especially on TTF, where we saw the summer 25, winter 25 spread be positive for quite some time. Due to the selling pressure that we've seen at the front of the curve, that has now flipped back to being negative, which has incentivized storage injections and caused capacity to be taken. And I think, again, what a point to note is, although you'll see selling pressure off the back of EU gas storage targets being changed, we've seen not only a significant amount of support in the winter 25 contract, but that's also spilled out into summer 26 and winter 26. So I think if that actually gets mandated, those three contracts on mainly gas, but potentially also on the power, could be well supported. This shows the 50-day rolling withdrawals or injections into storage. And you can see that comparatively to the last 3 years, we're off to a really strong start. And this is despite, comparatively to last year and the year before, us only having half the flow that we're getting, or that we were getting, via Ukraine, which is now coming via TurkStream. So I think that's a strong start to storage injections. This again shows kind of on more daily details. So you've got the orange line is how we've been injecting so far in 2025, and the dotted light blue line is the 5-year average. And you can see that although there are some days where we're slightly below, the majority has been far higher than the injections that we've seen comparatively over the last 5 years. And I think it's just worth reiterating as well that to get to that 85%, we're going to have to continue injecting at a strong rate. LNG pricing. As is the world we live in now, sensitivity to LNG pricing will continue to be prevalent over the course of this summer. We've seen an incredibly muted Asian demand so far, down to a couple of things. So macro pressures coming mainly from Trump's policy, and similar to us, they've had a very mild start to their summer, which has mitigated their demand. And I think that this curve shows the requirement for LNG for Europe, as comparatively our most competitive bid is over that summer period. So this does really express the need for LNG over the refilling period. And I think not only is it worth looking at the spread between the two commodities, one key mark where we've seen new buyers enter the market for LNG is around the $10 mark. You typically see South and Southeast Asian buyers enter the market at that level. And in turn, that serves as quite a significant support for the TTF and NBP contract as well, as it can't remain competitive for the LNG with the new buyers entering the market at that $10 range. There's a lot of talk around Chinese demand, and I think this graph shows year on year over the last kind of 5 years how their demand's changed. And I think if you take the highest case and the lowest case of the demand over the course of a calendar year, that changes by around 20 million tons. And I think, to put this into context, that accounts for around a third of total EU gas storage. The demand from Asia is currently low due to, as I mentioned earlier, macroeconomic pressures and cheaper alternative fuels, especially coal, which they can get from Australia. But I think this is why you see such a significant bid in Europe and the UK off the back of Chinese demand picking up, because they have an appetite for so much gas. Trump impact. So this graph shows an index and a commodity that aren't typically linked. And I think it just outlines the kind of macro drivers that we saw after the tariffs were put into place. So a few things have kind of, there's a few implications off the Trump tariffs, which I've listed on this slide. So you've got immediate impact coming from macroeconomic uncertainty, leading to reduced industrial activity and energy demand. And I think the most kind of fundamental driver that we've seen is redirection of LNG supplies as netbacks for US LNG producers for Asia have significantly decreased, and the revenue that they gain from exporting to Europe is far greater, which has increased Europe's pull for LNG. And I think as kind of a macro indicator, and one that in a macro-driven market tends to be a good focal point, is oil, which has seen a significant drop and has reached its lowest price level since April 2021. Fund positioning. So here we've got fund length and TCF pricing, and you can see that they are incredibly correlated. I think what we've seen, and I think I mentioned in the first slide, was that the sell-off that we've seen, although partially fundamentally driven, has been massively accelerated by this fund length. And I think moving forward, funds still have a decent amount of length to unwind. It's not quite the 300 terawatt hours that we saw at the height of February. I think there's been a lot of pain felt by these funds, but I think with the kind of support that we could see with the changes to gas storages, the kind of lagging bid that we have at the moment for LNG, we could see length be re-added, especially on the winter 25, summer 26 and winter 26 periods, because there is arguably a decent amount of upside risk to those contracts. Cool. So to finish off, some market considerations. Not only is there maintenance during May, but September in Norway, which could, as always, cause system tightness. Our competitiveness for LNG is going to be incredibly prevalent over the course of this summer to ensure that we inject and get to that 85/90% storage levels. Global LNG balance. So Europe will continue to be sensitive to any outages or maintenance on LNG facilities. Fund positioning, which was mentioned on the last slide. I think as last year was such a clear driver of pricing, I think if length were to be added, or on the flip side, if it was if we see decent price action downwards, they'll continue to be squeezed, and we could see some kind of over proportional moves downwards in pricing there. And then storage target amendments. So if the mandated level were to change, we could see a kind of sell off of that balance of summer 25, winter 25 spread. And in my opinion, summer 26 and winter 26 could potentially be supported as well. Cool. So I'm now going to pass on to Luke Mallard, who's Head of Strategy and Commercial Innovation.
Brilliant. Thank you, Lewis. Yeah, as Lewis said, I head up the Strategy and Commercial Innovation Department at Brook Green Supply. I've been here for a bit over 8 years now, so one of the first in through the door, and yeah, they haven't been able to get rid of me since. So I think they're now rolling me out on these to make sure that, you know, I live up to the title essentially. We're going to go through a little bit of power updates, then on to gas, and then a little bit about non-commodity forecasts as well. I will sort of caveat that by saying that we're not going to go into each individual non-commodity here. There's going to be more of a focus on the levies themselves. So yeah, we'll go on to that. So to begin with, it's been well spoken about, but we want to talk about the energy industry supercharger. So from April 2024, the maximum discount allowed on environmental levies, so that's RO, CFD, feed-in tariff being fit, have all increased from 85% to 100%, or the ability to go up to 100%, I should say. So we're seeing more exemption across those levies. Next, we're also seeing 100% indirect exemption for the capacity market. So that's a completely new introduction that came into effect from October 24 as well. So that's a big change there too. And then also we're seeing the introduction of the NCC scheme. So that scheme provides 60% discount on all network costs. So that would be your source, GNOS, and JAWS costs there. We'll go into a bit more detail on what those costs actually look like for non-EII customers, but effectively a new levy again for EII customers there across those network costs. So here we've got a bit of a forecast for EII. So this is the payable rate for non-EII customers. So when you account for the 60% discount that all EII customers are receiving, what that then looks like spread across all of the non-EII customers. So in some cases, losses for this may not be included on bills, but effectively losses should be included. So that also applies to transmission and distribution losses. For all customers, they should now be signed up to the Elexon portal where they are looking to claim this exemption. So we've gone through the first wave of that of Elexon, putting all of their details, I think via Excel, loading up all the charges, the rates that they've got payable, and making sure that they get that exemption. I think from our side as well, we want to highlight that any customers that have any questions on that would like support through that process, to please still reach out whilst you would have already gone for a round now. We understand that can be difficult at times. Some customers might have slightly different products that don't show those charges broken down. So if there are any questions around that, please reach out to us. With this as well, it's worth saying that there have been some teething issues, I think, in terms of new customers signing up to EII and also signing up to the Elexon portal. We saw quite a lot of pending applications, and when we go on to the next slide, I'll show you some of the figures that have changed from estimated to actual that have seen quite big jumps. So here we've got the estimated fund levy in the first column that you can see there. So that's all the way down to October. November's has now been released. I think off the top of my head, the figure for that is just shy of the October 24 figure. And then we've got the actual levy fund amount as well. So you can see there that for the first 3 months that have been confirmed now, we've seen quite big percentage increases. A lot of that, like I said, has been linked to Elexon having a lot of pending applications that they've now sort of put through onto the actual levy fund. We're expecting that to kind of smooth out a bit. So you can already sort of see it coming off from June 24. We'd expect the percentage change to be pretty flat as we get through to October 24 on the actual side. But as you can see here with the costs, whilst the figures are fairly large in the millions, obviously, when you spread that across the whole sort of set of consumption across the UK, it doesn't equate to a huge charge. You're seeing that EI support levy that's payable for non-EIs being around about that sort of 0.1 to 0.15 pence kilowatt hour figure. So it's comparable to things like AAHEDC. In certain months, maybe even sort of RCRC, it's going to be one of the lowest non-commodity costs on the electricity side. Now onto the nuclear RAB levy. So for this is again another new levy. Again, people have spoken about this quite a lot up to this point, but effectively it's going to be taking the exact same methodology that you've got for CFD. The one thing that is going to be different there is that there's the ability to recover money for this prior to the actual go live date of a nuclear site. So as soon as this levy is ready to come in, they'll collect monies via sort of that CFD scheme before necessarily energy is generating from those nuclear sites. So that's going to be the one key difference to the existing kind of CFD scheme, whilst it will follow the sort of natural CFD model. The scheme will be administered by the LCCC, so Low Carbon Contracts Company. And like CFD as well, it's going to have an interim levy rate, which is obviously going to be the largest sort of element of the rate, neutralisation mechanisms, and then also an operational cost levy as well. We're expecting this to, come in sometime over this year. We thought that it'd probably be sort of from Q2 2025, but there's now a good chance that this gets extended much beyond this, and that we actually do see it at some point over 2026. Even last month we thought that would be probably Q1 2026 at the latest. But as with all sort of non-commodity introductions on the electricity side, things seem to get delayed. So yeah, we're now not sure exactly when this is going to come through. We'll try and get information across to people as quickly as possible. But yeah, we're not expecting anything before July, but now it could be kind of as late as sometime in 2026. I guess as well on this, in terms of the cost itself, we're probably expecting that to be around about sort of £0.5 a megawatt hour. So again, it's not going to be a huge sort of new charge that's introduced, but it is going to have an impact on bills. It is going to be an additional charge for people that they didn't see before. Wanted to talk a little bit about Besuos. There haven't been huge changes to Besuos, but from April 23, we obviously saw the introduction of the fixed tariff. So going from that half-hourly variable charge to a fixed tariff. Over the course of the introduction of that, we've seen, I guess, huge over-recovery and huge under-recovery from the forecasts and sort of the set actual tariffs by NESO. So there's now a new change that's coming in there where it's reducing the lead time between the actual tariffs being confirmed and when they actually take effect. So on that one's now going to be coming through from the April 26th on the less lead time. So there'll only be 3 months prior to that coming through. So that will be confirmed around about December 25, January 26 for that new tariff coming in. The time period's still going to be the same, but you're just going from a 9-month lead time to 3-month lead time. So that should reduce the risk of over or under recovery from NESO on those forecasts, which is obviously a good thing for consumers, because at the moment we're probably seeing the source cost average to about 12, maybe £13 a megawatt hour. But we've seen tariffs as low as sort of £7 a megawatt hour, as high as almost £16 a megawatt hour. So we should see less over and under recovery, and it should be closer to the actual outturn of Besuos moving forward. Onto some gas updates as well. We tend to focus a lot on electricity, but we're talking a little bit more about gas because there might be some new introductions on that side. So the hydrogen levy being one of those. The impact of this at the moment is still sort of up in the air, but we expect it to be fairly small. You might see around about a 2% increase in gas prices for business users. At the moment, there are still ongoing discussions about the charging methodology. So I think at the moment, the industry is moving towards a volumetric design. So that will be based on gas shipped, and that should be a fairer distribution. There was talk of it being a meter point design, but that would probably have a negative impact on the domestic market, when you compare it to the business market, where consumption is so much higher on a sort of meter by meter average. And then in terms of how they're going to calculate the volumetric approach, we're expecting it to be a market share approach, which again should be a fairer kind of distribution of those costs. So with this, in terms of when we're seeing it implemented, again, there's always opportunity for things to get pushed. But at the moment, we're kind of expecting that to be April 2027, sort of no earlier than that. But as I've mentioned with other things, there's the opportunity that these things get delayed and pushed back. So next, we'll talk about carbon capture and storage a little bit. Again, there's not huge amounts of information on this at the moment. It's very unlikely to come in any earlier than April 2027. But, the government is looking to implement this. So information on it at the moment is fairly limited just because of the date that it's due to be rolled out on. But, we're expecting the funding approach to be fairly similar to the hydrogen levy. So it's another cost that we're trying to monitor as closely as possible, keep people up to date with, and pass information along as soon as possible. But at the moment, that's kind of most of the information we have on it. But it would mean another new introduction on the gas side, which, like I said, has been fairly static from a non-commodity point of view for a while. So moving on to non-commodity splits, as I mentioned, we're not really breaking out all of the non-commodities here. If anyone wants some information on that, it might be worth us doing sort of a separate webinar or sending out a separate report. But I just wanted to highlight, the split between commodity and non-commodity. Prior to kind of the last 6 months, we've had around about 3 years of crazy commodity wholesale action, which really has diminished the impact of non-commodities. Whilst there's been some big changes behind the scenes there, it just hasn't had a huge impact because the commodity price has been so high. What we're obviously now seeing is that the commodity price is much lower, still volatile, but much lower. So non-commodities are starting to come back to the forefront. Again, we're seeing that move on the power side where non-commodities are closer to making up 50% of the price stack, which is why engagement with the cost stack on the non-commodity side is so interesting now, because it really does have an impact on the price you pay, the product that's best suited for you. On the gas side, it's still much of the same until we see kind of an introduction of those new levies that we've spoken about, or potentially the sort of EII like levy that they're talking about on the gas side as well. Non-commodities aren't going to make up a huge element of the price stack. We need to see gas prices back down where they were at the start of COVID for it to be closer to 50-50. And then lastly, just to highlight the gas non-commodity side, this is only kind of focusing on the transportation elements, so transmission and distribution. But again, just to highlight that kind of year-on-year increase that we're seeing there. As you can tell, the overall impact is fairly low. We're sort of seeing prices going from around about 0.25 pence a kilowatt hour up to maybe close to 0.35 pence a kilowatt hour. So not huge differences. A lot of it is based on inflationary increases that could be impacted by things like Trump's tariff and sort of those macroeconomic factors, but not huge changes that we're seeing on that side. Again, if any customers or prospective customers would like a breakdown of their detailed non-commodities on the gas side, we're more than happy to provide that. Obviously, it is impacted massively by different capacity requirements and the type of meter. So it's sometimes difficult to show an indicative average amount on that side. Brilliant. And I'm going to pass across now to Harry Hellwood, our Head of Policy and Regulation.
Thanks, Luke. Good morning, all. I'm Harry Hellwood, and I head up the Policy and Regs team here at Brook Green. I think the obvious place to start from a policy and regs perspective is the review of electricity market arrangements, or REMA, and most importantly, zonal pricing. And then I'll go on to give an update on market-wide half-hourly settlement, or MHHS. We do love an acronym in this industry. So REMA and zonal pricing, I'm sure most of you will have come across this debate, which has been getting quite a bit of coverage. Despite it being a very complex set of policy proposals, it has actually managed to break through into mainstream media, as I'm sure most of you have seen. Firstly, by way of a quick background on REMA, it was first proposed under the Conservative government in 2022, and initially included various proposals looking to reform the UK's wholesale electricity market. One of the most radical proposals was nodal pricing, which would have created hundreds of different wholesale electricity prices around the UK, but thankfully this one was discounted. In autumn 2024, the current Labour government published an update on the discussions, making it clear that the status quo won't be continued. The UK will therefore be moving to either a reformed national pricing model or to zonal pricing. Within that update, the government also stated that they will be publishing a final decision in summer 2025. We understand that this will be June, so next month now. Following a decision, we don't expect implementation of the major changes to happen straight away. We think it's going to be towards the end of the decade that they actually come in, and it's likely to be further consultations addressing some of those details in due course. Before diving into zonal pricing, I did just want to briefly show the other areas of REMA, and they're shown on the slide here. So altering the current CFD mechanism, improving tenuous cost driver accuracy and predictability, reforms to the BM, reforms to further incentivize electricity storage, and then some non-market reforms as well, such as the Strategic Spatial Energy Plan, which basically involves the government getting more involved in where generation assets are located around the UK. There is a bit of a misconception that REMA is just zonal pricing, so I just wanted to share the other proposals as well here. Going back to zonal, as it's obviously sort of the major area within REMA, it's important to be aware that all of the details, particularly around the number of zones, are yet to be ironed out. This makes it difficult to understand and measure the full impact of the change. That being said, we believe we wanted to share our view on the pros and cons of the zonal pricing and national pricing, and the impact that we believe it could have on industrial and commercial customers. We would encourage you to get into contact with your account manager at Brook Green if you have any specific questions. So zonal pricing would create somewhere between 2 and 14 different zones in the UK. I think just back one slide, Mark. All of which have different wholesale electricity prices. Supporters of zonal pricing believe that this will lead to a market where investors will look to build generation assets in the areas that will become the most expensive in the UK, for example, London, to maximise their profit. As these zones that currently have low levels of generation start to generate their own electricity, it will reduce constraint costs. Constraint costs in the UK are very high, with wind farms in Scotland often having to be paid to turn off because we don't have the infrastructure to then move the electricity to other areas of the UK that need it. Ultimately, all electricity bill payers, including industrial and commercial customers, are paying for this, and there is minimal incentive for investors to build out infrastructure in high demand areas. Supporters of zonal also believe that businesses will relocate to areas of the UK which have the most abundant generation and cheapest electricity. So essentially, you'll get a sort of levelling factor whereby demand shifts to areas of abundant generation, but over time, generation shifts to areas of high demand, ultimately resulting in cheaper electricity for all. The principle is undoubtedly a compelling one for moving to zonal pricing, and should the UK government choose to go down this route, we'll ensure that at Brook Green we'll do all we can to support this actually becoming a reality for our customers. However, like any complex debate, it's not quite that simple. We don't think government are fully aware of the impact and scale of the change. When we have the challenge to try and meet 2030 clean power targets, we don't believe that transforming the market in this way is necessarily the best way forward. We have concerns that zonal pricing will lead to reduced market liquidity. Splitting GB into multiple price zones risks further eroding already low market liquidity, as trading participants have a reduced number of parties to trade with in a more fractured system. This increases the risk for suppliers, ultimately being borne by customers in the form of higher risk premia. We also have concerns about the winners and losers effect it has on energy prices, often referred to in the media as a postcode lottery effect. I think this is sort of the most publicised impact of zonal pricing, so I won't dwell too long on it, but creating different wholesale prices in the UK will result in winners and losers, with some areas of the country paying more for energy than others. The assumption that industrial and commercial customers will simply relocate to cheaper zones is, in my opinion, naive. There's obviously other factors at play than the cost of energy when a business determines where its operations are going to be located. There is potential that customers will be shielded from certain price increases, but again, there's a lack of clarity over how this would work. Then the sort of final major area of concern is the impact on renewable investment. Reforms on the scale will lead to uncertainty for investors, and we're already starting to see the effects of this. An investment hiatus will be disastrous for the government's 2030 and 2050 goals. It's likely that zonal pricing will lead to higher costs of capital for generators due to the smaller zones having more volatile pricing. Whilst reducing curtailment costs is a good thing, curtailment costs do provide a level of certainty for investors in regard to their asset. So clearly we have some concerns about the impact of zonal pricing on the market and on our customers. But as previously stated, it's difficult to measure the scale of this due to the lack of detail at the moment. We're engaging with political stakeholders to make sure that they are aware of the scale of the change ahead of the decision this June. We're working internally on modelling the impact of the change on our customers, and should zonal pricing be approved, we'll hold specific sessions and webinars on the topic. As previously mentioned, I'd encourage you to get into contact with your account manager if you have any specific questions about potential impact on your business. Ultimately, we don't think this is the right time to be attempting to go for a change, which we believe is the most significant since privatisation. We understand the issues with the current wholesale market, and we're supportive of reform. We know change is required, but we believe this can be done incrementally via a reformed wholesale pricing system. Whatever the government decides to do, we'll ensure that we keep you updated and work with you to maximise whatever benefits there are from the reforms. So I did want to predominantly focus on rumour and zonal pricing because of its potential level of impact and the close proximity of the decision date. That being said, I did want to touch briefly on market-wide half-hourly settlement, as this is an area we get quite a lot of questions from customers and brokers. At Brook Green, we continue to progress through the required testing and qualification steps to ensure we're fully prepared to deliver market-wide. Many of our customers are already settled on a half-hourly basis and are therefore familiar with the insights and operational efficiencies that this offers. Market-wide will extend those benefits across the industry and enhancing the tools and services available to all energy users. And on this slide here, you can see some of the benefits that industrial and commercial customers will see from market-wide. Ultimately, market-wide is designed to empower customers, especially those with complex or high volume energy needs, to take greater control over their energy usage and costs. And we're committed to helping you take full advantage of these opportunities. So moving on now to the final slide from me. I wanted to just give you an update on where the industry is up to in relation to market-wide. The programme has unfortunately experienced quite a few delays, with the latest due to system integration testing taking longer than expected. Ofgem has stated that the necessary testing is now not expected to be completed until August 2025. This delay then has a knock-on impact to the other milestones that you can see on the slide. And as you can see, M16, so the final milestone, is now not due to be finished until July 2027. As previously stated, though, we predominantly supply half-hourly metering already, which means we can already pass through many of the benefits that market-wide is going to bring. That being said, we're keen for this programme to be fully rolled out so that all our customers can benefit. As always, we'll keep you updated via webinars and the customer report. I'm going to hand you back over to Mark now for the Q&A.
Right. Thank you very much, guys. Really appreciate it. So again, if anybody does have any questions, please do get them submitted onto the Q&A form. We'll just try and pick up on some of those questions at this moment in time. So first one is, what do you think could influence price on the back end of the power and gas curve? I suggest that's one for Lewis.
So on that, I think the two commodities trade very differently. I think gas, you've obviously got the storability, but power, you don't. So I think it's fair to say that gas is going to be a lot more influenced by what's happening at the front end, whereas the back end of power is typically generators selling out and hedging some of their generation. And I think a massive driver for that is UKA pricing. We've seen that have quite a rally over the last couple of weeks, breaking £50 on the DEC 25 contract and continue going. So I think that's kind of key influencer on the power side to look out for that back end pricing.
Great. Thank you, Lewis. Possibly another one for you. You mentioned the base peak spread, but how much liquidity actually exists in the peak market?
So sometimes it's quite good, sometimes it's quite bad. I think in super choppy markets, the illiquid products, be it peaks, be it working day 6, be it more of the bespoke contracts, aside from the base load, tend to be pretty illiquid. But in kind of small range days, liquidity can be quite good. More so on the spread, so the base peak spread, rather than the actual outright. You typically see better liquidity there.
Great. Thank you again, Lewis. A question here, possibly for you, Luke. What would be your view on the future 3 to 5 years of REGO back to power? Are people more keen to move to hourly matched REGOs?
Yeah, I think that the market is definitely moving in that direction. We've seen a lot of suppliers adopt hourly match REGOs, ourselves included in that. And I think customers are far more engaged on that side of the market now as well. I think we've seen a lot in terms of greenwashing. So, people are obviously moving more towards PPA-backed energy now as a result of that. And I think working with hourly matched REGOs is just a further kind of push in the right direction, let's say, to ensure that people understand their consumption, understand their needs, and ultimately look to link themselves with assets, whether it is a physical asset in a PPA or whether it's a certificate-backed sort of trade in the sense of REGOs, to make sure that it's as closely aligned to their hours of use as physically possible. So yeah, I definitely see the market moving much more towards hourly matched REGOs.
Thank you, Luke. Probably another one for you. Please, can you explain how you're charging the EII support levy to customers on pass-through contracts? It looks like it's like you've charged back to April 2024. Is this correct? I thought the charge was only applicable from April 25 onwards.
Yeah, completely. So, we showed the table earlier of the estimated fund amounts that now cover from April 24 the way to November 24. Our view of the EII levy and its application to non-EII customers is that there's such a long period between the estimated levy being introduced and then the actual levy being introduced a year later for such a small charge that we felt it was better to pass that charge through to people as quickly as possible, in line with kind of those months of consumption, to ensure that people weren't paying effectively somewhere between 0.1 and 0.2 pence a kilowatt hour for a charge a year after the fact. We see similar things across other charges as well. I don't think there are any suppliers in the market, for example, that go back and refresh charges based on different settlement runs. When you get through to RF or something, 14 months after the fact. So our view of that EII levy is that we should be charging it real time so that people can start paying for that charge. Get it under their belt. It's like I said, it's a small charge. For sort of a 10 gigawatt hour customer, you're talking kind of maybe £1,000 a month on their bill for that overall charge. So not much at all in that sense for that level of consumption, given that their bill would be their monthly bill, total bill would be much higher than that. So we wanted to get that to customers, in real time, so that a year down the line they're not looking at massive amounts of reconciliations, seeing staggered 6 monthly for the estimated fund coming out, and then also another staggered 6 months on top of that for the actual fund then being reconciled.
Great, thank you, Luke. Question for you, Lewis. What is your outlook on wholesale gas and electricity prices over the next 5 years, please?
Cool. So I think the outlook would be, and we've started to see it already, and it's going to be most likely down to the renewable build out that we're seeing. We've already seen gas demand drop significantly, and this isn't just in the UK, it's across Europe as well. And as that build out continues, you'll see gas pricing drop relative to power. The spark spread will depreciate in value. And I think what we'll see at a more prompt basis is more extreme levels of pricing, just down to the fact that we won't have that consistent supply of gas, as that will naturally get phased out. That's how I think pricing is going to develop. And I think it's also worth mentioning as well, and this is kind of more shorter term, the build out of LNG in 2026 is expected to ramp up significantly. And that's also going to pressure gas and therefore power pricing too.
Thanks, Lewis. Harry, one for you. Do you believe that manufacturers are really going to move facilities based on zonal pricing?
No, to be honest. I think that's one of the major reasons that we don't support it. You obviously will get one or two that are able to do that, but the fact is there's so many more things that businesses have to take into account if they're going to move or where they're going to locate their premises. It's often like cultural ties and workforce ties to certain areas. So to assume that commercial and industrial customers would just relocate is, as I said, naive, I think.
Great, thank you. If we take a couple more questions, there's quite a few. By the way, we will reply to any questions that we don't answer in this session separately, so everybody can see sort of a full Q&A session from this. Let's take one. Do you expect zonal pricing to drive greater utilisation of flexible energy markets, quick and slow reserve, balancing mechanism, etc.? Will flexible energy markets also be split into regions?
I think that's part of the support for it. I think potentially you would get some more flexibility, but I think, again, until we see some of the more detail that hopefully comes out in June, I couldn't really give a definitive answer. And I think people that are giving definitive answers either way, I'm not sure how they're getting to that point with the lack of detail, basically. So I think you are seeing a bit of sort of like lobbying on both sides, when in reality we need to just wait to see the full detail before making a full decision on the full impact.
Okay, and if we take one more, Do you expect to see a decoupling in fund positions and gas wholesale prices over the next 2 seasons? Probably more for you, Lewis.
I don't think so. No, I think over the course of last summer, that positioning was so prevalent, and I imagine they made so much money that they'd kind of, it would be unlikely that they'd neglect it as a commodity to get into. So I think it'll be prevalent moving forward.
Thank you very much, everybody. Really appreciate your time for this morning's webinar. Thank you very much to Harry, Lewis, and Luke. We hope you have a fantastic rest of the day, and we hope to see you all soon. Thanks very much.